Okay, so welcome to this week's class. We're already on week 3. I can't believe it. How fast time has gone by. This week we're going to do options. So I pulled up the learning module. An option is a derivative. So try to understand what an option is. An option is a derivative. What it means is the price of the option is based on the price of another security. So the price of an option is based on the price of another security. So there are two types of options: call options and put options. Call options are the right to buy a security at a certain point in time at a certain price. A put option is the opposite. It's the right to sell a security at a certain point in time at a certain price. So for instance, you can have a stock that's trading at $100 a share, and you could buy a call option for $110 strike price that goes out 1 year. That means for the next year, if the price of the stock goes above 110, you have value in that option, right? So if it goes to 120, the intrinsic value would be $10. Now, because it's an option, it also has a time premium. In other words, like an insurance policy. Think about it like a life insurance policy. You pay a premium because you don't necessarily want to use, obviously, God forbid, you don't want to use the life insurance policy, but the premium allows you to have the option that if something does happen, somebody collects on that premium. Same thing when you lease a car. If you lease a car, you're basically buying a put option. What does that mean? Well, think about it. In the end of the lease, you can sell the car back to the company, given whatever parameters, mileage and everything. Basically, the company is giving you a put option. So you could sell it back at a certain price at a certain time. So call options, these are the basic symbols. And the payoff is the stock minus the strike price. Okay? And to look it up, so if it's out of the money, like remember my example, 110, 110, right? Let's say we have a 110 option, right? So let's say we have a 110 option and the stock's at 100 and it never goes above 110. Well, then think about the math. Think about the math. When you look at it mathematically, you would have no value to that option. There would be no value to that option. So that would mean it came out of the money. Okay? Okay? Okay. So there you go. That would be the out of the money option. For a put option, as long as the value of the underlying asset is below, because it's a sale, you'd be in the money. So now let's take that same example. If you have a $100 stock and you have a put to sell it at 90, it wouldn't be in the money until the stock went below 90. So if it closes anywhere at 90 or above, your option would be worthless at the end of the period, which we're going to use 1 year. Options go 3 months, 6 months, 9 months. They go out as much as 2 years, and you can even customize options if you work with the big banks, if you have a big enough position. But generally speaking, the listed option market goes out 3, 6, and 9 months. And I know I'm sharing my screen here. I just want to show you something. If you want to really get into the in-depth part of options and you really want to carry this, and learn a bit more about it, 1 minute. There's a little bar up here that I have to deal with. So bear with me. Okay, good. All right. So 2 things I would recommend. This book is one of the Bibles of options, very readable, and really anybody who traded options on Wall Street read it. Very readable, very easy to understand. Of course, it deals with options, but options is a strategic investment. So it's a very good book. Very good book. Other site I would recommend to go into is the CBOE, which is where a lot of options are traded. And you can hit US options, and there's a wealth of information about options here in the CBOE. Wealth of information. You got a lot of stuff here. So just make yourself available. Feel free to get in there and take a look at this stuff. Because I know a lot of people take these classes or have taken classes with me in the past, try to understand what this is about. They will absolutely want to learn more. And certainly options are intriguing and they're risky. I mean, if you buy an option, it could be very risky because you could lose all your money if the option doesn't stay in the market. So be aware of that. But on the other hand, if you use it for insurance, so say I own a stock and I want to protect the downside because I'm worried about a market downfall, I can buy a put. So I can own that, say, I stock at 100, maybe buy an 80 put, and that would give me the ability to put an insurance policy in at $80 a share. Now that is using options to take risk out. So there's no question. There's a lot of ways to use options. Now, CBOE will give you quotes. You can get quotes on Yahoo Finance. You get quotes just about anywhere. And if you have an online trading account, of course, there's tons of quotes. But this is like the most active options from this morning, right? We're on Monday, this October 19th. You see there's Apple's, there's these are options on the S&P 500. So you start to see what the most valuable or the highest trading options are. And there's the expiration and there's the strike price. So these are all strategies that are going on. There's a ton of stuff you could find from the CBOE. And that's why I guide you to this area. That's why I'm guiding you to this area. Okay? All right. So that gives you a little like insight where you can go to find things. They give you the same example in Google that I just gave you. Okay? But let's take a look. You go into the spreadsheet, you can model the payoff. So you could look at different prices and it'll tell you if the option would be in or out of the money. But it would then kick out a chart. And this is a typical option chart. So notice this is my call. Once the call goes in the money, then I could start making money. But I have to make back my premium too. So in this case, if I paid, go back to my example. If I have a stock trading at 100 and I bought 100 call that expired in 1 year, but I paid $5 for the right for that call, but you pay this we call time premium. It gives you the option. I only have to lay out $5 and I'm controlling the same amount of shares, but it has to stay in the money. Once I make back my premium, it's pure profit on the way up. If all I own is the call, obviously, if I combine it with a stock position, and there's different ways to combine these. You can short the stock or sell the stock, and you can buy the call. You can buy the stock and short and sell the call. There's a lot you could do with these options, and that's why I direct you to the options as a strategic investment. But this is what the payoff would look like. That's what the payoff. I want you to look at that for a minute. By the way, the key word this week is clock. Clock. Clock is the key word, like clock. Tells time. Okay, clock. And then the put option is the exact opposite. And and you look at the Excel spreadsheet that the school provides, they do a great job. And you could see that now you make money if the stock goes down and you make up your premium. So this is essentially how the option works. Okay. So think of the option as an insurance policy that you could either buy or sell. I mean, think about it. If there was a market, you could sell insurance premium to people, and then you'd have to make good if they collect. It's the same thing. You could sell this put, in which case you would lose money if the stock came down because you would have to buy the stock at 90. This was 100. If I was using that number, whatever the option strike is, you would be obligated if it was a put to buy the stock. Here, if you bought the option, you collect money once the stock goes down because you own the option. You can go either way. You could sell the option or buy the option. Okay? Sell the option or buy the option. Or you can combine it with securities to make a position, right? I can buy it. I can buy the stock and buy the put and protect my downside. Of course, it's going to cost me more than what I paid for the stock. So say I have a put that is struck at 90 for a year and it trades at $5, and I buy the stock at 100, so I spent 100 on the stock. I have to pay another $5 for the put. I paid 105, but below 90, I'm protected. I can't lose any money. So I pay an extra $5 for that risk protection, like paying for an insurance policy. Well, you're not, this is not an online class. I mean, this is an online class, but I understand you're going to watch this in your own good time. But I should mention that since you're not here in person, which is fine, this is where I would say any questions. This is where I would say any questions. Okay. So, what does that mean? Feel free to ask me questions. You have my cell. I know I've talked to Mike a couple of times, 917-613-9725. If you're watching this video and you see something that doesn't make 100% sense, contact me. Contact me. Now, the Black-Scholes model is a model created by Fisher Black and Myron Scholes and Robert Merton that values these options in a continuous time. Even though this isn't a heavy calculus course, we use calculus and stochastic calculus, which is a variation of calculus. So we could look at these and value these options on a continuous basis. Continuous basis. Right? On a continuous basis. Which means that the stocks trade constantly. Now, I gave you a video in my announcements this week. It's a Vimeo. It's a documentary that was on BBC a number of years ago that explains the Black-Scholes model. It is one of the most fascinating finance documentaries. It's about an hour that I've ever seen. You're not required to watch it. If you really want to learn about how this was developed, and then there was actually a company that used it, a fund company, and they lost a fortune because they over-relied on the models. It's a fascinating documentary, and it really talks about the beginnings of Black-Scholes. Please feel free to watch it and ask me questions. So the big determinant of an option is going to be time. We know time. It's like an insurance policy. The more time I have on my insurance policy, the more protection I have. And volatility. What's volatility? Volatility is how much my stock moves up and down. Now, obviously, if my stock's moving up and down a lot, my option's worth more. I don't know how obvious it is, but it should be worth more because it gives me more of a chance to utilize that option. Think about my $100 stock again. If it moves in a very narrow band, like 101, 102, 198, 99, my option may never see the money, and I don't need to own an option that's on something that's not risky, like a life insurance policy. If I got a person who has good health and takes care of themselves and doesn't have a lot of health issues, well, they could pay that for that life insurance policy for years, and it's a good thing that they never collect. Obviously, nobody wants to collect a life insurance policy, but you've given up that premium, which is a good thing. Well, let's say you're a very careful driver and you bought an automobile policy, right, which we all have to buy, but you never get into an accident, thank God. Well, you've spent premiums, that's what they are, and you never use it, which is fine. Hey, you should go your whole life without ever having to collect because that means you haven't had the issues, right? That you don't want to have accidents, things like that. Somebody crashes into your car while it's parked, that's a different thing. But you have never had any of those different issues. Time has gone on and you pay for this premium and you haven't gotten anything out of it. So, but if you're a volatile driver, if you do a lot of speeding, if you're a risky driver, if you're a risky person, well, the volatility is going to make your option worth more. Unfortunately, it's not a good thing, but it's worth more. And volatility follows a random walk, which means we don't know. We know where volatility's been. We know how a stock has moved in the past. We could use that. But what we don't know is where the stock is moving going forward. What we don't know is where the stock is going forward. Because really, when you think about it theoretically, the past is no guarantee of the future. The past is no guarantee of the future. And since the past is no guarantee of the future, then we definitely are in a position where the model that we use has to assume that stocks follow a random walk or that they're random. And also to get the probability, and this again gets into statistics, that it follows a natural logarithm. And it's part of the Black-Scholes formula. So, and that there are no transaction costs. Natural logarithm allows us to just normalize the returns, which means it's like using percentages. We can compare any sets of returns by making it log normal, because it becomes like a percentage, right? If I look at the percentage of assets in a balance sheet versus the percentage of assets in another balance sheet, when we talked about accounting earlier, well, I could compare Coca-Cola to any company. As big as Coca-Cola is, I could compare it to a small soda company because the percentage of assets, liabilities, and capital will be the same. So log normal sort of does that for us, right? That's what log normal does. A log normal. So then we have the formula, we put in these variables, and this is the Black-Scholes formula, which is the log of the stock over the strike. This is how we determine the probability. D1 is the probability, plus the risk-free rate of return, plus what we call variance divided by 2 times time. And it's a lot of math here. And we divide it by the standard deviation, which is again, a measurement of risk. I showed you the normal distribution last week. I showed you that little video. Times the square root of time. And what this does for us is we can now take this D1 number that comes out, plug it into a normal distribution probability, which I showed you last week, and find what is the probability of this stock being in the money at a certain period of time. Remember, we looked at this. I'm going to show you again. And it's going to look something like this. So it's going to be a probability function. And this allows us to plug these numbers in and see what the probability is. It's all going to be positive because if it's out of the money, it's not worth anything. But it shows us what the probability is of this stock falling in the money. And that's what D1 does for us. D2 is a function of D1. So really what the Black-Scholes formula says is what's the stock times the probability it'll be in the money minus the present value, what the strike is worth today. So we get a value today, not 3 months from now. But this is a 1-year option. We don't want to know what it's worth in 1 year. We want to know what it's worth today. So the first part of this tells me the stock times the probability that the stock will be in the money minus the strike at a present value. And the put is the opposite, obviously. And that's the beauty of the Black-Scholes. Follows a standard normal distribution. And all of these things, if the stock is below the money, if the stock is trading at 100 and the strike is at 90, obviously you got a higher probability. If the stock is at 100 and the strike is at 110, the option price, we have a lower probability. If the risk-free rate is higher, then we should have more probability. The risk-free rate is lower. If volatility is higher, we get a higher probability because we have a high probability of being in the money. If the variance is lower, we get a lower probability. So that's what Black-Scholes does for us. And then if you plug the numbers in, a $60 stock with 3 months left, which is a quarter of a year, and an exercise price $2 above, current risk-free rate in the economy is 1%. The volatility for their returns based on past performance is 40%. Calculate everything, and those are the numbers you're going to come out. Let's look at these numbers again and plug it into a formula. You know, there's tons of, this is not like an obscure thing. The Black-Scholes model is something you see everywhere. You can get a ton of information and calculate. Let's hope it works. So what's the strike price? They call spot price is the same as the stock price. It currently trades at 60. So let's plug 60 into here. And the strike price, the price we want it to go to, is 62. And the time for expiration is 0.25 of a year, which Volatility, we were told, was 40%. That only leaves, what's our risk-free rate now? Risk-free rate is 1%. So what's the call price? Let's see if our thing is accurate. Delta is a call price of $3.99 and a put price. Pull up a million of these, not a million. There's a ton of these calculators. Notice you can change the input value. If I change it to 61, I get a little bit of a different price because the strike is actually a little higher and it's going to make my call work less, but it makes my put work a little more. If the stock goes to 100, well, what would we expect? We would expect our call to be worth a lot of money, right? Because now I got a 62 strike, I got at least $38 of value. Let's see what happens. I got a price of 38 and a put price drops to 4 because now it's so deep in. What if it goes down to 50? Well, notice now the put is not worth a lot, but the put is worth a lot. This is a great little tool. I like this one. I'm going to include it in the notes because it gives you the ability to really see how different things affect the option. Okay, hold on 1 second. So, volatility affects an option. If I lower volatility, let's go back to the original prices, right? Let's go back to the original prices. If I lower volatility, or let's raise volatility, watch how the options are worth more because I have more variance. If I lower the volatility, and one thing you gotta know about volatility, it changes over time. It changes over time. So that's one of the failings, or that's one of the tough things about Black-Scholes. Notice it goes down. So I'll put this on our class. See if I can include it. I want to include it in our class. I will remember to include it. I'll put it up on the module 3 work, the option calculator. Just gotta take care of something. So what you want to know is how the option moves back and forth, the differences in prices, volatility, and everything else. And it's a good thing to start to learn, especially if you want, options really, we see options all the time. It's not just in the stock market. We see options in many things, many things. We see them in, like I said, in a lease, in a car lease. There's a model you could use. We see it we see it all over. So when we do financial statement forecasting, sales growth, depreciation, dividend payout, right? You can actually, and this is something you should do, and they tell you about, they're really just talking about some circular model and how to fix it on Excel. So it's just more of an Excel issue. But take a look at it, read through it, play with it a little. But what they're trying to, well, not what I think, what they're trying to tell you is each model also has option value. So think about equity. Stock is really an option on the company. Why? Because if I take on debt, the debt holders take the loss first. I'm using their debt to create leverage. And the leverage could give me more value, right? I can double my money, triple my money. But if this company goes out of business, yes, I lose all my premium, which is the equity, but the debt holders lose first. So these models show us how debt is really a function of the equity option. It's really a function of the equity option. Okay. And where do we see real options? When we make business decisions. Most projects contain real options, and financial managers use them in capital budgets. So where do we see projects that have real options? Well, let's take a look. I love this example. Company owns an oil well, right? The best guess today is that the well is worth $50 million. In 5 years, you make a decision to develop the oil and at a cost of $70 million. So you're spending basically 20 million more. Wildcatter, or a person who just buys and sells, that's what a wildcatter is. They buy and sell the rights to, wildcatter buys and sells the rights to oil wells and sometimes develops them, sometimes just keeps trading them like a trader. Offers you to buy the well for 10 million. So would you give them 10 million today? That's the value of the option. You don't know what the future holds. But if the oil well's value increases 5% a year, the oil well will be worth 63.71 in 5 years, which is less than the 70 million. And traditional capital budgeting tells us that the well is worthless. But wait, there's a chance the oil could be worth more than 70 or even 80. That's volatility. If that's the case, your company nets 10 million. So the scenario based on a 5-year European call option, because that's what this is. A European call option is an option that doesn't pay until the very end and doesn't pay a dividend. This doesn't pay dividends, right? It's an oil well. Stock price is 50 million. The Black-Scholes model is well suited for this. Assuming variance is 30% and the risk-free rate is 5%, the value of this call is 11.58 million by plugging it into the Black-Scholes, which means don't sell for 10 million. You have given all those parameters that we assume, the option on the well should be worth more, and you can actually plug it in and work out the number. So again, the school does a great job with this. Right? They really do. I'm not to be a cheerleader, but the school does a great job. I'm really very impressed. So why don't we do this? Let's go to module 3, which is this week. And I want to, on the lesson content, give you that option model so you can play with it at home. And I think it's helpful to play with this at home and show how when you move price, volatility, risk-free rate around, how it affects the option. Content. There you go. And just to go over some of the other stuff, binomial model is another model that we use, which is sort of a little bit of a different. It's a lattice model where we can see the problem with Black-Scholes, or one of the issues is it's a closed model. So once we make all those assumptions about volatility, risk-free rate, stock, those things stay the same until the end. With the binomial model, one thing you need to know is you can change them. Okay? Can change them. I'm not going to get too deep into that, but you can change them. And these are the knowledge checks and the part of the book that you're going to need to do. You need about 24 hours. This is a very important chapter. Then here's option pricing. I got to tell you, they do a great job here. And this is your playlist. So you'll have plenty of information here. Okay? This is the ebook chapters. This is what I just taught you from. Right? Now, as far as the assignments go, let's go back to module 3. You're going to do a knowledge check. And make sure first initial, last name, followed by an underscore and the name of the assignment. So you would do it this way. And there's your written assignment. Calculate D1 and D2. You could do all of this with your Excel spreadsheet. Do a 1-period forecast. Do it all with an Excel spreadsheet. Okay? So once again, here's where I would tell you, any questions, but we're not live. We're not, you're not here, which is fine again. I don't have a problem with that. But this is where we would get to that. Okay, here's where we get to that. Again, options is a strategic investment, great tool. Great tool to use, and not great tool, great text to read if you want to go deeper into this option. The other thing is the option model that I gave you. That would help you to kind of verify your numbers. and just follow everything that the school gives you on the spreadsheet. And this should be something that should be able to handle. Here's the spreadsheet. Click on it. Very comprehensive spreadsheet. Very comprehensive spreadsheet. There you go. They have everything you need here, basically. Okay, make sure to stay on top of your assignments. Do not fall back on these assignments. Go to the course calendar. Okay, go to the course calendar and make sure to stay on top of these assignments. Very important. Okay. All right, that wraps it up for this week. Contact me if you need anything, both Jessica and Mike, and it's great to meet you guys. Thank you.